Hi, everyone. Welcome to your latest Carson's Take 5. Sonu, the year isn't over yet, but we're going to cheat a little bit. And this week's Carson's Take 5, we're going to be thinking about 2026. I'll just put a bow on this real quickly. We've been bullish this year. We think there's a little more upside the rest of this year. But let's think bigger picture, right? I mean, people watch these videos, we're not just thinking 1 or 2 months. We're thinking the next 14 months. You did some great work on just kind of what the average year, and there's no such thing as average, which we'll talk about, but the average year does better than you think. Let's talk about 2026 here.
Yeah, look, we are coming back to off the 2 years where we had 25% returns for the S&P 500, 2023 and 2024. This year, so far, fingers crossed, we have 7 weeks to go. Things look pretty good. To finish at maybe 15 to 20%. It may even end up above 20%. We've got some solid momentum over the last 6 months coming into the last 2 months of the year. And this positive seasonality and all of that. But you look back in history, to your point, we were just talking before this, my favorite chart that you produce is that if you look at annual returns, calendar year returns from 1950 to 2024, 75 years, only 4 years have seen the average return between 8 and 10%, right? And for the most part, if you look at most other shops, they'll tell you, oh, what's the expectation for 2026 or 2025 or 2024? Oh, it's 8 to 10%. Well, that's the average, right? You can't go wrong predicting the average. But guess what? It's never the average. So
let me just jump in. I know where you're going to go with this. I'm going to set it up with a joke.
Okay.
So there's this statistician. He put his feet in the bucket of ice and his head in the oven. And they said, hey, how do you feel? He goes, on average, I feel pretty good. So anyway, I'm setting that up for you because I know where you're about to go with this. Go ahead.
So then you think, okay, let's just look at the data, see how it's distributed, right? And guess what? It's, in statistical parlance, it's a right skewed distribution. That just means more often than not, returns have been really good. Yeah. And by really good, I mean above 10%, above the average, right? 62% of the time, if you look at calendar year returns, 62% of the time, returns have been greater than 10%, above average, right? 39% of the time, in fact, it's been above 20%. That's close to 4 in 10 times. Right.
That's crazy.
Then think, let's put some conditionality. Like we've been positive on the economy. Right. And we don't think, not giving anything away by saying we don't think there's a recession next year. OK, let's look back and put some conditionality on these annual returns. Let's take out years in which there was a recession and just look at returns then. Things look even better then. Right. 68% of the time when you don't have a recession, returns are above average, above 10%. 42% of the time, returns are above 20%. So, don't be surprised by above average returns.
No, that's some great bunch of numbers there. And I know sometimes we hear numbers, our heads kind of explode. But I think I love the way you framed it, which is when things are going good, they can keep going good for a lot longer than you think, I think is the key thing. And these very videos like a year ago and even 2 years ago, too, I dusted off the numbers. After a 20% year, you know what happens? That next year does even better than your average year. And here we are. And I know the year is not over, but that's what we're seeing. One more from me, Sonu, then I'll let you wrap things up here. I'm saying this year is like a slingshot. You think about a slingshot, you pull it back, you release it, with momentum. Well, we had that near bear market in April. Okay, so down about 19%, give or take, on the S&P 500 on a closing basis on April 8th. That's pretty scary. We all lived through it. Congratulations. Now we're on the other side of it. The slingshot is now we're probably going to be up at least double digits this year. That's our base case. Year's not over, but it's looking like we're going to be up double digits. Only 3 other times, Sonu, in history have we seen years like that, which are down a whole bunch and then finished up double digits. And you know what happened that next year, Sonu? Every single time that next year, so this is 2026 in this instance, was higher, up almost 20% on average. I get it. A sample size of 3 is not the biggest sample size. I still think it's extremely powerful, this momentum we've had off that panic low that we had back in April. How do you want to wrap things up?
No, look, don't sleep on momentum. Right? To say, don't underestimate momentum. Momentum begets momentum. I feel like we've said that a number of times, but it bears repeating. Right? Yeah. Just because the market gains a lot over the last 3 years doesn't mean it suddenly has to fall. Bull markets don't end of old age, right? Something has to happen. And usually it's a recession. And then you think, okay, are we likely for a recession? We think not, right? We don't see the signs of that. Doesn't mean there are issues in the economy. The labor market is slowing. Payroll growth is slowing. Doesn't mean there are problems. There are no problems. Doesn't mean. But, we don't see a recession right now. And then you think of tailwinds like the trade war looks to be behind us. The Fed looks to be on their path of continuing cutting interest rates. That's a tailwind as well, right? And then, we're going to get a whole bunch of tax cuts and tax refunds in the first half of next year. All these are tailwinds for the market and the economy. So I think we have a lot of things going for markets as we move into 2026.
Well, hopefully that's music to the ears of everyone that watched these weekly Carson's Take 5, because we've been bullish for quite a while, and we're still pretty optimistic as we think about 2026. We'll see you right next week. Thank you. Take care.